Hello, everyone, and thank you for joining us. I'm Jeremy Dreyer, Chief Business Development Officer here at GoMining, and it's a pleasure to welcome you to today's session. By way of my personal background, I've spent over 25 years in blockchain, Bitcoin mining, real estate development, and capital markets, leading strategic growth initiatives, managing over $100 million in revenue at the minority, and founding Trade Finance Network to help scale access to structured finance in emerging markets. At GoMining, I lead our global growth strategy, overseeing strategic partnerships, corporate development, and the expansion of our mining infrastructure across key international markets. GoMining is a global leader in Bitcoin mining with over 8 years of operational expertise. We currently serve more than 3 million users, delivering more than 4,000 Bitcoin to those users, and operating over 7.5 million terahash of mining capacity across our fleet of global data centers. Our 200-person team also spans across 25 different countries worldwide. We recently launched GoMining Institutional. It's our dedicated platform for professional investors, family offices, and capital allocators. It's built to make Bitcoin mining accessible, scalable, and compliant to those seeking real-world digital asset exposure without needing to manage machines or navigate hosting complexities. Our goal today is to provide insight on how institutions are approaching Bitcoin mining, not just as a yield opportunity, but as a strategic infrastructure allocation. In a moment, you'll hear from my colleague Fakul Mia, who leads our institutional business. He'll walk through our approach and how we're helping capital allocators integrate mining into their broader portfolio construction. After that, our research analyst, Nico Smid, will take you through the technical and economic landscape of the mining industry, covering key trends like Bitcoin price development, institutional adoption, the evolution of mining hardware, hash rate efficiency, and how institutions are now evaluating mining alongside other Bitcoin strategies. So, with that, over to you, Fakul.
Great. Thanks, Jeremy. Hi, everyone. I'm Fakul Mia, and I lead the institutional business here at GoMining. My personal background spans nearly 2 decades in global finance, including 15 years at Morgan Stanley, where I served as global head of institutional margin financing and risk. During that time, I led cross-regional teams across major financial hubs, managed multi-billion-dollar exposure, and building enterprise risk systems to support the firm's most sophisticated institutional clients, including building out Bitcoin futures. Since transitioning into the digital asset space, I've worked across both TradFi and DeFi, helping design and scale blockchain infrastructure solutions with a focus on capital access and investor alignment. Currently, my role at GoMining is focused on working closely with allocators, family offices, and institutional investors to help them understand, evaluate, and gain structured exposure to Bitcoin and Bitcoin mining as part of a broader investment strategy. With GoMining Institutional, we've created a platform specifically designed to meet the needs of professional investors, one that removes the operational barriers traditionally associated with mining and replaces them with simplicity, transparency, and control. Our solutions are fully managed and infrastructure backed. They're structured to offer long-term exposure to the economics of Bitcoin mining with institutional grade governance and risk frameworks layered in. And importantly, we recognize that mining is not the only way for institutions to gain exposure to Bitcoin. ETFs, spot holdings, and public miner stocks all play a role in the market. But those instruments often come with volatility, lack of yield, or limited visibility into what's really driving performance. What mining offers, especially at scale through a structured strategy, is something a little different. You get exposure to Bitcoin's foundational infrastructure, a non-correlated source of yield, and a long-term asset-backed return profile that fits well within a diversified digital asset allocation with annual liquidity. More allocators are beginning to view Bitcoin mining not just as a niche, but as a real-world asset class in its own right. Our job at GoMining Institutional is to make that access frictionless, professional, and aligned with the standards institutions expect. To help frame the opportunity, it's important to understand how mining actually works, how rewards are generated, how costs evolve, and where the economics break down across the value chain. And that's why we have Nico, our research analyst, who will be covering in the next segment. He'll walk you through a masterclass on Bitcoin mining, everything you need to know, starting from the fundamentals and taking you through network growth, hash rate efficiency, energy trends, and how mining compares to other Bitcoin investment strategies. So without further ado, Nico, over to you.
Thank you very much for that introduction, and let me quickly pull up the first slides. Yeah, so I'm Nico Smit. I'm a research analyst at GoMining Institutional. I have a background in economics. Started my career as an institutional fundraiser, and then worked for many years at the Ministry of Foreign Affairs in the Netherlands, whereby I guided companies in doing business internationally. In 2017, I got invested into Bitcoin, and 2021, I became an active miner and decided to move full time to the space. I joined the team of GoMining Institutional to position the institutional part of GoMining. So today I wanted to walk you through the evolution of Bitcoin mining. It's a booming industry, you'll see shortly. And I want to show you how it became a new asset class for institutional investors. So shortly the agenda, I will go over some Bitcoin price development, look back over the last decade, how Bitcoin became adopted by institutions. Then I'll move into the mining part, explain how mining works, explain about how Bitcoin miners make their money, how they are rewarded for all the work they put in, how the Bitcoin mining industry grew, industrialized, professionalized, and became a global industry. I will look shortly at the power usage and how the efficiency of the industry also improved, and then compare mining to other Bitcoin investment strategies. Show you that it's significantly different. And finally, I will finish off with some explanation about how complex it is to actually operate Bitcoin mining facilities, and that it's not for everybody to operate such a sophisticated data center. So first off, I'll look into the unparalleled growth and institutional adoption of Bitcoin itself. Here you see a chart whereby I zoomed out all the way back to 2012, when Bitcoin was still trading for just a few dollars. That's where the first bull market, a big bull market of Bitcoin started, and it blasted all the way up to $1,000, which was a remarkable milestone, and left many skeptical people surprised by the performance of the assets. As it's a young asset, and at that time especially, it was a small market cap. It requires little capital to move price up and down. So with the young assets, it's normally normal that it comes with some volatility. So you saw after price was shooting up, it corrected downwards, and before we moved into the second bull market of Bitcoin, which was the 2017 run up all the way to $20,000. And this run up was mainly driven by retail investors. So a lot of retail investors got to know about crypto and about Bitcoin, and they piled into to Bitcoin and started investing. Also then price went parabolic and had to process all that purchasing all demand, and it took a while before we moved into the next secular bull market, which was the 2021 bull market. And the big difference between the rise to 20,000 and the rise to 69,000, which was the top of the 2021 bull market, is that in 2020, 2021, the first institutions started showing interest in the asset. Institutional money flowed in, and it was companies like Tesla that announced that they had Bitcoin on their balance sheet, and also where MicroStrategy, now rebranded to Strategy, they started their buying spree in 2020. The current bull market that we're in, or the uptrend that we're in, is also driven by institutional adoption. The biggest push in price was triggered by the approval of the Bitcoin ETF. This Bitcoin spot ETF saw a lot of inflows, especially in the beginning of 2024 when these ETF products were approved. And last year, after the election of President Trump, we saw that the market became very bullish again overall, and also in the Bitcoin space because of the Trump administration's positive position towards cryptocurrencies and Bitcoin specifically. And that pushed Bitcoin price all the way to $100,000, which is a significant milestone, and many Bitcoiners have been waiting for that milestone, so it was widely celebrated. Bitcoin over the last 10 years has been outperforming many traditional assets, including the Nasdaq 100, which you can see here. Bitcoin got adopted widely because of its scarcity. It has a market cap of or a hard cap of 21 million Bitcoins that will be minted in total. And this digital scarcity drives the narrative of Bitcoin being a digital gold. But also the uncertainty around inflation and has people investing in Bitcoin as a means to store their value. And over the last 10 years, Bitcoin has had an average growth of 77% year over year. So it's very impressive performance. And that impressive performance is validated here, where you see an overview of all biggest assets in the world based on market cap, and Bitcoin has entered the top 10 of these big assets globally, whereby currently it's hovering between the 8th and the 9th position, depending on the price. And last year in Q4 of 2024. When Bitcoin was performing very well, it even was taking position 7 and surpassed silver for a short moment. This is a bar chart that represents all the holdings of Bitcoin, and you can see that the most Bitcoin is held by the ETFs. The ETFs are offered by financial giants like BlackRock, Van Eck, Fidelity, and you see that all these important financial institutions are offering this product because they see that added value. It's estimated that over 600 companies or investors, institutional investors, have some sort of exposure to Bitcoin, of which most have ETFs on their balance sheets, and big important players like Morgan Stanley, JP Morgan, Wells Fargo, they all have exposure to these Bitcoin ETFs. The biggest holder of Bitcoin is the IBIT, which is the ETF of BlackRock, and it's followed by MicroStrategy, who has been aggressively buying since 2020. If you go further down the line, you see the first orange bar. That's Mara Digital. That's a publicly traded Bitcoin miner. So Mara is the biggest holder amongst the miners, followed by Riot, CleanSpark, and Hut 8. And what's interesting about these miners is that they have a big amount of Bitcoin, not only because they mine and hold their Bitcoin, but they actually have been buying additional Bitcoin to add to their balance sheet. Next to institutional adoption, it's also interesting to see that Bitcoin has been playing more and more an important role in the financial or global financial system, and has become part of monetary policies of countries. In 2021, El Salvador announced that they adopted Bitcoin as a legal tender. El Salvador is not a big country, but it was a very important moment for Bitcoin because it was the first small domino to fall. And as you can see, in 2025, the US established a strategic Bitcoin reserve. So that small domino led to bigger domino stones falling alongside with them. The US currently is the biggest holder amongst the countries worldwide, with over 200,000 Bitcoin, and they are followed by China and the UK. And next to adopting Bitcoin as a strategic asset, you see more and more countries moving into mining as well, because they see that adopting Bitcoin mining is a way for them to diversify their revenue and to monetize often underutilized power infrastructure. So Oman announced a big investment of 1.1 billion in Bitcoin mining infrastructure and is working hard on becoming one of the biggest mining hubs worldwide. And you can see that in Argentina, YPF, the state-owned oil and gas provider, is selling gas to Bitcoin miners. Also, Ethiopia has been a leading country in Africa by welcoming Bitcoin miners to use their hydropower production. And last year, in just 10 months, they earned over 55 million in Bitcoin mining deals. And in addition to that, they make money on the VAT or the tax that they earn on the power, but also on the importation. And also Bhutan, a small country in the Himalaya that depended a lot on tourism and agriculture, was able to diversify their income by welcoming miners to utilize the hydropower that they produce. And El Salvador, next to adopting Bitcoin as a legal tender, they started mining on the geothermal power that's being produced by their volcanoes. So in the next section, I want to explain a bit more about what mining entails and how the industry developed over the years. And to explain how Bitcoin mining works is sometimes a bit difficult or challenging. It's a complex process, but to explain it in simple terms, people transact on the network. So there's participants that buy and sell Bitcoin on the network. They pay a fee for that. There's people that send money to the family or they pay a bill using Bitcoin. And all those transactions are collected and guarded by miners and put into a block. So the miner, they construct a block and then start using their computational power. So they have specialized computers that can do a specific task, cryptographic task, which is called hashing. And what they try to do is to find the digital fingerprint of that specific block, which is called the hash. So once this hash is found, the miner they broadcast the block to the network. It gets verified by nodes if that hash is indeed matching, and if so, it's updated. The blockchain is updated and the block is added to the blockchain. The miner that is able to produce that block is being rewarded in two ways, by block subsidies and transaction fees. So looking at the first part of that miner reward, the block subsidy, you can see that the block subsidy is being cut in half around every 4 years, or 210,000 blocks. This event is called the halving. So the idea behind this is that through halving the block subsidy, that hard cap 21 million Bitcoin that is being minted is guaranteed. And it started off with a high block subsidy in order to attract miners to the network and start mining. And throughout the years, this block subsidy becomes smaller and smaller. And the idea is that with adoption of Bitcoin and increased transactions, that transaction fee becomes a more important part of the total reward, and the subsidy becomes less of an important part of it. So when the Bitcoin mining network was launched, miners could earn 50 Bitcoin per block. So every 10 minutes they could earn 50 Bitcoin. And after 4 years, that was cut in half to 25. 4 years after that to 12.5. And last year in 2024, April 2024, we saw the last halving. And currently the block subsidy is 3.125 Bitcoin per block. If you look at the pie diagram on the right, it's interesting to see how beautifully programmed this algorithm is, because each cycle, the amount of Bitcoin that's being minted, new Bitcoin that's being mined, equals the block subsidy. So you can see that the first cycle block subsidy was 50 bitcoins, and 50% of all the bitcoins were mined. When it was cut in half to 25, during that cycle, 25% was mined. And after or at the halving last year, a total of 93.75% of all bitcoins were already mined. In total, there's 32 halvings, and by the year 2140, so over 100 years out from here, miners are going to depend fully on transaction fees. And here you see a visual representation of the transaction fees and the blocks being added to the blockchain. On the left, you see the purple blocks are already added to the blockchain, and on the right, you see blocks being formed and transactions waiting to be confirmed in those blocks. So the transaction fees are unlike the subsidies. The transaction fees are unknown, so they vary a lot. While the block subsidy is known, and we can exactly calculate when we can expect what kind of subsidy. The transaction fees, they depend on various factors. An important factor is that each block has a certain size, so up to 4 megabytes. And so this block space, as we call it, is scarce, and people that transact on the blockchain network, depending on the urgency, they are willing to pay a higher price to get prioritized and included into the next block. So the demand for block space and the urgency for transacting is going to determine how much people are going to pay for the transactions on the network. On the left, you see that the blocks that were confirmed already and mined. You can see below the names, Foundry, Binance, via BTC. These are the pools that were able to produce those blocks. Then within the blocks, you can see how many transactions were included. So that last block that was added has over 4,000 transactions. And then the amount of total transaction fees that were included in that block. In this case, it was 0.073 Bitcoin in that specific block. The screenshot or the snippet you see here is actually at the moment where demand is not that high and the transaction fees are not that high. There's been moments already in this cycle whereby the amount of transaction fees were higher than the block subsidy itself. And the further down the line we go, the further down the halving line, let's say, the more important these transaction fees become, and the bigger percentage they will make up of this miner reward. So before moving on, I would like to shortly explain two important metrics. One is hash rate. We already mentioned a couple of times the word hash rate, but it's important to understand that this is the speed at which mining hardware can perform a particular cryptographic operation called hashing. And so if you look at the network hash rate, we talk about the total computing power that miners contribute to the network. And hash rate is denominated in different terms. So if you look at the ASIC miner, so at the machine itself, we talk about terahashes. Well, if we look at the mining fleet, so if you look at a facility or operation that consists of various mining computers, we use the term petahash, which is 1,000 terahash. And if you look at Bitcoin, the Bitcoin network as a whole, we use the term exahash, which is 1,000 petahash or 1,000,000 terahashes. And another important metric for miners is efficiency. This is how much power a machine or a mining fleet is using to produce a certain amount of hash rate or computing power. And this is measured in joules per terahash. And it's important to understand that the lower the joules per terahash, the better. So a higher efficiency is actually a lower number. And here you see two machines, two of the first ASIC and one of the most recent ASICs. And over 10 years, a lot has happened on the hardware side. So when Bitcoin launched, the first miners were using their laptops, CPUs, and later on GPUs to mine Bitcoin. until the competition became too fierce and it was very hard to mine with GPUs. That's where the first ASIC Bitcoin miners were introduced. And ASIC stands for Application Specific Integrated Circuit, which means that these computers are developed to do one thing and one thing only, and that's to mine the algorithm that they're designed for. And in the case of Bitcoin miners, it's to mine with the Bitcoin algorithm. In 2013, the first miner was launched, the Avalon 1, which had a hash rate of 66 gigahash, so that is 0.066 terahashes, and it was consuming 600 watts. That's an efficiency of over 9,000 joules per terahash. Fast forward to the year 2024, one of the most powerful air-cooled miners was launched, the Bitmain Antminer S21 XP, which has a hash rate of 270 terahashes per second. So in a bit over 10 years, the computing power, the amount of hash rate went up by 4,000%. The power consumption of this machine is 3,645 watts and an efficiency of it has an efficiency of 13.5 joules per terahash. So that efficiency has improved over 99%. So it's very impressive to see that while computing power has gone up very aggressively, the efficiency has improved 99%. The industry has also, or the sector has become an industry, let's say. The Bitcoin mining evolved from being run by individual hobbyists at home, first on their computers, and then later adding these ASIC miners to their home, mining in garages, to large-scale fleets that are run in professional data centers and have sophisticated cooling systems. There's still home mining going on. There's still individuals that mine, but they have to get very smart about their mining in order to be able to compete with these professional data centers. And many at home reuse the heat to heat their garage or office. So if you look back at the network over the last 5 years, you can see that at the start of, or 5 years ago, the network was still at 100 exahashes, while at the end of 2024, we reached over 800 exahashes. So in 5 years, the network grew over 700%, which is very impressive. This year, the network started off a bit slow, but in this month we reached the 900 exahashes already. So the aggressive growth is continuing until into the new year. Last year was a record year with 292 exahashes being added to the network. So the network grew with over 56%. And this while the previous year, 2023, was already a record year. So in that year, 250 exahashes were added and the network almost doubled. If you compare this to the previous years, you can see that the deployment of this new hash rate has really accelerated over the last few years. Bitcoin mining has also become a global industry. So you can see that worldwide, there's miners securing the network, as we say, whereby the US is very dominant. So in the US, around 36% of all hash rate is being produced. Within the US, Texas is responsible for 50% of this production. So there's many miners flocking to Texas because of their energy metric and the amount of energy that's available and the friendly business environment. In the US, after Texas, big mining states are Georgia, New York State, and you see states like Oklahoma, Tennessee, North Dakota. They're all catching up. After the US, Russia is the biggest miner, and Russia is followed by China. It's interesting to see if you look at South America, you see in the middle an orange dot, that is Paraguay. Paraguay has the second biggest hydro dam in the world that produces 14 gigawatts, of which 7 gigawatts goes to Brazil, 7 to Paraguay. But Paraguay is a small landlocked country with not too many people living there and not a lot of heavy industry. And Bitcoin miners moved in to use this underutilized and abundant energy that's available. In the Middle East, you see Oman and the UAE being dominant, and in Africa, you can see that Ethiopia is taking the lead there. Also, they have a lot of hydropower that is underutilized. So by welcoming miners, the country is able to monetize that underutilized power. In Europe, you see quite not a lot, let's say, mining going on, except for the Scandinavian countries. The reason being that electricity is expensive, power is expensive in Europe. But in the Scandinavian countries, there's quite some hydro production, solar and nuclear power. But more than that, the cold climate allows miners to resell the heat they produce with their computers for district heating or greenhouses, and that offsets a big part of their costs. Here you see estimated power consumption of the Bitcoin network as a whole. 5 years ago, the network was consuming an estimated 6.5 gigawatts, while now, or at the end of 2024, that was 25.5 gigawatts. So this meant in 5 years that the power consumption increased with 292%, which is a big number. But if you then compare it to the hash rate growth, it's way less than the 700% of computing power that was added to the network. And that means one thing, and that's that the network has become more efficient. And that you can see in this chart. The line of efficiency is going down to the right, which means a lower number, higher efficiency. And what's interesting to see is that the last year, the improvement in efficiency started stagnating. And the reason for this is that the first ASIC miners that were produced, they used chips that have the size of 55 nanometers. This chip size was reduced all the way to 3 nanometers, so the latest models are produced with 3 nanometers, but there's a limitation to the reduction in chip size. Because the smaller these chips become, the higher their sensitivity for failure rates. So there's only so much more we can do on the chip size and the efficiency of these machines. So my expectation for the foreseeable future is that efficiency gains will mostly come from operating facilities in an efficient way and because of more sophisticated cooling systems. So what are some factors that have an influence on the hash growth in the coming years? Well, as I mentioned, the efficiency, but also the hash rate output, so the density of computing power of these machines is an important factor. So we need less and less infrastructure and power to produce that same amount of computing power. Bitcoin price dynamics, obviously very important. Bitcoin price is of big influence on the profitability of mining. So if price goes up, demand for mining goes up, and if price goes down, it will slow down the growth. Governmental incentives and regulatory clarity also play an important role, as we've seen in Ethiopia. If there's a Bitcoin mining friendly environment, and they're welcoming to foreign investors to develop this infrastructure, mining can be developed quite quickly, as 600 megawatts was developed in 2024 alone in Ethiopia. Something that might slow down the hash rate growth is the competition for power infrastructure. So the demand for power by AI, HPC, high performance compute, has gone up quite a bit over the last few years. And you see that these high performance compute data centers, AI data centers, they buy up all the big power blocks. So there's a big competition for power infrastructure, a big demand for power coming from AI, HPC. And next to that, the electrification of our economy also is of influence. You see more and more electric vehicles, but next to that, many houses are getting off the gas and they are becoming fully electric. So the electrification of our economy will demand more power and will compete for the power infrastructure with miners. Also, potential constraints or disruptions in the semiconductor supply chain can have an influence. This we saw around the COVID pandemic. If there's a constraint or disruption in that supply chain, semiconductor producers of factories might prefer to sell their chips to big off-takers like the mobile phone industry and put some Bitcoin miners, Bitcoin mining manufacturers on hold. Also, raising electricity costs can be of influence. Electricity can be up to 80% of the operational expenses, so it's very important what the cost of this electricity is and how that influences profitability. We saw that during the energy crisis in Europe, prices went up and it had a direct impact on miners. And currently, the natural gas prices are relatively low, so there's a chance that those might rise in the future. So now I want to move into to a comparison, comparing mining to other investment strategies in order for investors to understand what kind of role an investment in Bitcoin mining can play in their portfolio. And I think the most important difference is the fact that Bitcoin mining is not a passive investment. If you buy Bitcoin or hold a Bitcoin ETF, it's relatively passive. If you buy spot Bitcoin, you have to manage your wallet, your keys, but other than that, you don't need to do a lot. And the same goes for ETFs. It sits in your trading account, but it doesn't require an active management of the instrument itself. If you look at mining, mining is actually a business. It's a company that you're running, so it's a very active investment. Miners need to scope sites, they need to acquire land, they need to negotiate with the utility or power provider to obtain a good contract. They need to build out that facility, procure machines, deploy them, configure them, repair and maintain them. So it requires a lot of activity, let's say. It's really a company that you're running. Another big difference is that Bitcoin mining provides an infrastructure-backed exposure. As you can see in these pictures, a data center, Bitcoin mining data center, requires either a building or it can be in a containerized solution, but it requires some type of facility. And inside that facility, there's sophisticated cooling systems, electrical infrastructure like transformers and cablings. You see a lot of racks inside those facilities, and obviously the ASICs themselves. So there's a lot of physical assets that go into mining, while buying Bitcoin is a pure digital play. A big difference also is that Bitcoin mining is cash flow, generates a cash flow, so it generates an income. If you buy Bitcoin, you assume it or you invest in it because of its potential price appreciation. But in the case of Bitcoin mining, it also generates an income. Each day, miners mine Bitcoin and it's being sent to the wallet, so it's a regular, consistent cash flow that they're building up. Next to that, mining provides opportunity to create compounding returns. So if you invest this income, the Bitcoin mined in a efficient way, you're able to obtain more hash rate, more computing power, and thereby increase the amount of Bitcoin that you can mine. Also, a big difference is the exposure to market volatility. Bitcoin, in the case of Bitcoin investments, you're exposed to its price, but in the case of Bitcoin mining, it's more complex. Bitcoin mining is exposed to the volatility of price, but also difficulty increasements, the transaction fees, as we discussed before, energy markets can be of influence, and also these machines, these ASIC miners, they have their own cyclicality and market dynamics. And finally, Bitcoin mining is a long-term investment. So if you buy Bitcoin and want to sell it, it's very easy to do. You can trade your Bitcoin 24/7. If you have an ETF, you may be limited to market hours, but those markets of spot Bitcoin and ETFs are very liquid. While a long-term investment in Bitcoin mining is less liquid. It's harder to sell infrastructure. It's harder to sell these ASIC mining machines. Although the ASIC mining market is a very lively market, it's harder to liquidate these machines in comparison to Bitcoin. Many consider Bitcoin mining as the ultimate way to dollar cost average into Bitcoin. Dollar cost averaging has been a popular investment strategy because of Bitcoin's volatility. So timing the bottoms and the tops, it's very difficult. If you mine, you receive Bitcoin on a daily basis. So whether the market is bullish or bearish, whether there's fear in the market or greed, it doesn't matter. You have a consistent income in Bitcoin. And this dollar cost average strategy has been proven very profitable in the past. Finally, I want to explain shortly the complexity of operating a Bitcoin mining facility. Setting up a facility and operating a Bitcoin mining business is not for everybody because you need to deal with various challenges. First of all, you need to navigate the energy market, so you need to understand energy pricing, and many miners are required to have a sophisticated energy trading strategy in order to be competitive. Also, securing affordable power is a challenge. So at home, you'll pay a consumer rate. If you want to mine with that consumer rate, you're not going to be very profitable. So you need to be able to secure industrial rates, lower affordable rates, and obtaining these rates is a timely process. You need to build a relationship with utilities or power generators and negotiate these power purchasing agreements, which is something that takes time. It takes building a relationship. Also, operating a facility requires a wide variety of skills. You need technicians that are able to configure and repair machines. You need electrical engineers that can ensure that the electrical infrastructure is built out in a secure way. You need people that have knowledge of HVAC or plumbing, depending on the setup. So it's a wide variety of skills that you need, in addition to understanding the numbers and running a management team within the company. Also, the economies of scale is very important in the industry. It's a capital-intensive industry, so the economies of scales allow you to secure that affordable power. So if you have a bigger load, if you offtake more power, you're able to negotiate better with utilities or power generators. But also for the build out, if you buy all these inputs for the facilities and the mining equipment themselves, if you buy in bulk, you're able to negotiate better terms and conditions. And that's it for my part. Together with the GoMining institutional team, we regularly publish articles on the website. So if you want to learn more about Bitcoin mining, I would suggest to go to institutional.gomining.com. Also, we'll publish monthly market updates. So if you want to stay ahead in the world of Bitcoin mining, I recommend you to visit the site. And so now this was my part. I want to give the floor back to Jeremy.
Thanks, Nico. That was a fantastic deep dive. So, and thanks to everybody else who joined us today. We hope you found the session insightful. This is just the beginning. As Nico kind of pointed out, we'll be hosting these webinars monthly. covering everything from mining economics and infrastructure trends to institutional allocation strategies and market outlooks. In the meantime, make sure to follow us on LinkedIn and X, aka Twitter, and check out the GoMining institutional website that Nico just shared for regular market analysis, thought leadership, and updates from our team. Thanks again for being with us, and we look forward to seeing you next time. Take care and goodbye.